A recurring pattern in financial history is unmistakable, a moment when abstract mathematics turned into destructive reality. It's a point when leverage, originally fueled by paper fortunes, transforms into a relentless engine of liquidation that erodes genuine wealth. This cycle first manifested starkly in 1929, when nearly 90% of the stock market's value evaporated in less than 3 years. Similar crashes occurred in Japan in 1989, leaving their market devastation largely unrecovered, and across the globe in 2008, when the entire financial system teetered on the brink of total collapse within hours. Each time, those caught in the turmoil believed they were different, that advances in technology and sophisticated policies had rendered such crashes impossible, yet they were mistaken. The destructive force behind these events isn't external, it's built into the very fabric of the system, mathematics. There exists a precise, 7-stage sequence that unfolds with mechanical certainty once specific conditions come into alignment. Currently, in the year 2025, we find ourselves at stage 5 of this sequence, the same stage that in 1929 led to catastrophe within just a year and a half. This isn't prophecy, but pattern recognition. Once recognized, this pattern can't be unseen. To understand how such crises develop, let us journey back to 1920. The Great War has just concluded, leaving America emerging as a creditor nation for the first time in history. European countries owe billions of dollars to American banks, while the industrial capacity built to sustain wartime needs begins shifting toward peacetime markets. Meanwhile, the Federal Reserve, founded only 7 years earlier, in 1913, is still mastering how to control the nation's money supply. In 1920 and 21, the U.S. economy plunges into a sharp, though brief recession. Factories that had previously operated at full capacity for military contracts suddenly face collapsing demand. Unemployment spikes sharply, commodity prices plummet, and financial distress spreads. However, a transformative shift occurs that sets the stage for what follows. The Federal Reserve opts to stimulate the economy by slashing interest rates. By 1924, the central bank's discount rate drops to a mere 3%. Commercial banks, taking their cue from the Fed, begin lending generously. Credit, an essential catalyst, becomes inexpensive and abundant. Mortgages are issued freely, and installment plans enable ordinary Americans to purchase cars, refrigerators, and radios. For the first time, consumption is no longer dependent on savings. Consumers can acquire goods immediately and defer payments. Yet, at this point, few grasp the implications of this surge in credit. When borrowing becomes excessively cheap and persists for too long, human behavior naturally adapts. The incentive to save diminishes. Why bother saving when debt is almost interest-free? Likewise, why invest in long-term, productive ventures that take years to yield returns when one can speculate in assets that double in value within months? The entire economic incentive structure shifts, from a focus on production and patience to speculation, from savings and cautious investment to borrowing and leverage. By 1925, this transformation is well underway. Stock prices climb steadily, initially modestly, but enough to attract attention. People who had previously never considered stock ownership begin asking friends and neighbors about this new wealth-generating opportunity. The encouragement is widespread. It's easy, they're told. You don't need much capital. The concept of buying stocks on margin, borrowing funds to amplify gains, becomes the striking new financial weapon. Margin lending, often called the original weapon of mass financial destruction, operated in a deceptively simple, yet dangerously powerful way. Imagine walking into a brokerage with just $1,000. The broker might say, "That's a good start, but why limit yourself?" They then suggest using your $1,000 as collateral to borrow an additional $9,000. Suddenly, you have $10,000 to invest in stocks. If those stocks increase by just 20%, instead of earning $200, you have made $2,000. Your initial $1,000 stake has tripled to $3,000, a stunning 200% return achieved solely through borrowing. The appeal is obvious. The leverage amplifies gains exponentially. However, the peril remains hidden until prices begin to decline. For example, if your $10,000 investment falls by even 10%, Your holdings are worth $9,000, and you owe the broker $9,000 plus interest. This means your entire $1,000 initial investment is wiped out. Should prices continue to fall, you can end up owing more than your assets are worth. At that point, the broker issues a margin call, demanding that you deposit additional funds immediately. If you fail to do so, they will sell your stocks at whatever price they can get to cover the loan. By 1927, margin lending has surged dramatically, with borrowed money for stock purchases soaring from $1 billion in 1921 to over $8 billion within 2 years, a staggering 800% increase. But these figures only hint at the true danger. $8 billion represents roughly 8% of America's entire gross domestic product. To put it into current perspective, with today's U.S. GDP at approximately $28 trillion, that would translate into about $2.2 trillion in margin loans for stocks alone, an unimaginable scale. The situation worsens because it's not merely individual investors borrowing from brokers. Banks are borrowing from other banks. Some banks are borrowing from non-bank lenders, who in turn borrow from entities holding idle cash. The entire financial system morphs into a towering edifice of debt, where each level depends on the continued functioning and belief that the system can sustain itself. A specific example illustrating this insanity is the late 1920s call money market. This is where brokers borrow the funds they then lend to their margin clients. By 1928 and early 1929, interest rates in this market sometimes soared to 12, 15, and even 20% for overnight loans. Imagine paying 20% interest overnight just to borrow money that can be lent out at even higher rates. Brokers do this because they can charge clients yields of 30, 40, or 50% annually, betting on stocks that are rapidly ascending. This is the epitome of bubble logic. Borrow at any rate because returns far surpass borrowing costs, until, inevitably, they don't. Corporations also jump into this frenzy. Companies producing real goods, operating factories, and employing workers look at their idle cash reserves and think, why earn 3% when I can lend it overnight at 12? So they do. By 1929, major industrial corporations divert funds from their operational needs into the call money market, behaving more like banks than productive enterprises. Unlike banks, which at least attempt to evaluate risk, these corporations chase high yields with money that should be used for inventory, machinery, or wages. This marks the first stage of the pattern, artificial prosperity driven by easy credit, not genuine growth or productive investment. Instead, it creates a speculative financial carnival attended by those eager to leverage debt to chase rapid gains. During the late 1920s, artificial prosperity was fueled by overly easy credit. This wasn't genuine economic growth or meaningful investment in productive enterprises, but rather a frenetic financial spectacle where widespread borrowing was used to speculate, all under the illusion of creating real wealth. And the numbers clearly reveal this pattern. Between the years of 1925 and 1929, the Dow Jones Industrial Average surged from 100 to 381 points, a staggering 281% increase in just 4 years. Yet, corporate earnings only grew by about 30% during that same period, with dividends rising at a modest pace. The soaring stock prices were almost solely driven by expanding valuation multiples. Investors were paying exponentially more for the same earnings, fueled by the collective belief that prices would continue to escalate indefinitely. It's crucial to understand that back in 1925, the market didn't seem to be in a bubble. It appeared to be a sign of progress. America was in a state of economic exuberance. Factories operated at full capacity, cities expanded rapidly, and daily life was transformed by the advent of emerging technologies such as radio, automobiles, and electric appliances. These innovations marked genuine breakthroughs, creating tangible productivity gains. Henry Ford's assembly line revolutionized manufacturing, General Electric brought electricity to millions, and RCA made radio a household staple. Despite these authentic developments, stock prices were escalating at a pace far faster than the growth in the real economy. The widening chasm between true economic progress and inflated asset values was the very danger point. Inevitably, these diverging paths must reconverge. And when they do, the adjustment is rarely smooth. When the disconnect becomes unsustainable, it doesn't close gradually. It closes in a burst of violence. By 1927, a pivotal event unfolded that would prove critical. The Federal Reserve, observing the stock market's relentless ascent and the inflation rate remaining subdued, chose to lower interest rates further. They reduced the discount rate from 4% to 3.5%, partly because they were responding to requests from European central banks, notably Britain and Germany, whose economies were still crippled by war's aftermath and needed monetary support to stimulate growth. Additionally, since the international monetary system was still based on the gold standard, higher U.S. rates would have caused gold to flow from Europe to America, draining European reserves. To maintain the global gold reserves, the Fed eased monetary policy, which in turn accelerated the upward spiral of the stock market. By 1928, speculation had become part of the national fabric. Every day, newspapers carried market updates, radio programs discussed strategies, and ordinary Americans, those who had never previously owned stocks, opened brokerage accounts in a frenzy. Teachers, factory workers, shopkeepers, they all bought stocks on margin, convinced they'd uncovered the secret to wealth. Among the most dangerous phenomena was the booming investment trust sector. These trusts functioned as primitive mutual funds of the era, pooling investors' money to buy diversified portfolios of stocks, ostensibly to reduce risk. While diversification and professional management sounded promising, many of these trusts had a deadly secret. They employed leverage, massive borrowed money, to amplify returns. The mechanics were straightforward but perilous. An investment trust might raise $10 million from investors and then borrow an additional $5 million from banks. This strategy effectively doubled the amount of capital dedicated to stock investments, vastly increasing potential gains. When stock prices rose, the trust's net asset value soared, and because investors aimed for higher returns, their shares traded at premiums to the trust's intrinsic value. Some trusts went even further, buying shares in other trusts, creating layered webs of leverage that functionalized as financial bombs waiting to explode. This soaring leverage ensured that when the market turned, losses would multiply quickly and severely, turning the entire system into a volatile house of cards poised for collapse. In the summer of 1929, some investors recognized the mounting dangers beneath the euphoric market. Among the keen-eyed was Paul Revere, metaphorically speaking, working tirelessly to sound alarms. Their warnings were often ignored or dismissed, yet these skeptics understood the mathematical reality. The inflated valuations could not persist indefinitely. Despite the widespread optimism, a few insiders and cautious observers began building positions against the market, betting on a collapse that most others refused to see coming. This awareness of impending danger was often coupled with strategic moves, such as shorting stocks or gradually reducing exposure, all while the bulk of the crowd remained blissfully engrossed in the illusion of perpetual progress. These early warnings, rooted in sound analysis, contrasted sharply with the prevailing blind faith in rapid, riskless gains. Yet, ultimately, it was the collective arrogance of the masses, believing that prices could only go higher, that sealed their fate, leaving the skeptics poised to profit from the imminent unraveling. Joseph Kennedy, renowned as one of the most triumphant speculators of the 1920s, amassed a fortune that might have reached tens of millions through orchestrating stock pools, coordinated schemes where affluent traders artificially inflate the prices of a specific stock, creating an illusion of demand, only to eventually dump their holdings onto unsuspecting retail investors who joined the frenzy too late. Such practices were not only legal but also commonplace, forming the foundation upon which many fortunes were built. By the summer of 1929, however, Kennedy was beginning to exit his positions. The well-known anecdote, likely apocryphal yet illustrative, recounts that Kennedy decided to liquidate after receiving stock tips from his shoe-shine boy. If shoe-shine boys were speculating, Kennedy reasoned, then nobody remaining was left to buy. Yet, beneath this story lies a more calculated understanding. Kennedy grasped the intricate mathematics of leverage and forced liquidation that underpins market collapses. He knew that when a market is heavily borrowed against, say, with 10% margins, a mere 10% decline in stock prices can wipe out an investor's equity. Once the equity vanishes, brokers issue margin calls, demanding more collateral. If investors fail to meet these calls, brokers are compelled to sell the stocks to recover their loans, precipitating a further drop in prices. Falling prices trigger more margin calls, leading to a vicious, self-reinforcing cascade that feeds on itself. Once such a cascade starts, it can only be halted through the complete unwinding of leverage from the system. Recognizing this, Kennedy not only sold his holdings but also began building short positions, bets against the market, aiming to profit as stocks declined. His strategy was purely financial, positioning himself to benefit from the impending disaster rather than trying to prevent it. Kennedy was not alone in this concern. David Marshall, a legendary financier who had advised presidents and amassed wealth through previous crises, had also been reducing his positions during 1929. By that time, Marshall was in his late 50s, having lived through the panic of 1907, witnessing bubbles swell and burst. He understood the warning signs. In his memoirs, Marshall reflected that by mid-1929, he could already sense danger in the atmosphere of Wall Street. Conversations had taken on a manic tone, confidence bordering on fanaticism. The optimism had turned into a near-religious fervor, reminiscent of past excesses he'd seen before a collapse. He recalled that bubbles seemed to always end the same way, suddenly and decisively. By October of 1929, Marshall had shifted most of his holdings into cash and government bonds, effectively withdrawing before the storm. But it wasn't just American investors who sensed the brewing danger. European funds had been quietly retreating since August. British banks, observing the relentless climb of U.S. stock prices that defied any fundamental valuation, began the process of liquidating their U.S. holdings throughout September and early October. These seasoned financial institutions had experienced prior manias: the South Sea bubble in the 1700s, railway speculation in the 1840s, and knew well that when valuations fully detach from earnings and speculation becomes ubiquitous, it's only a matter of time before the bubble bursts. They understood that when everyone believes that this time is fundamentally different, that technological progress or a new era justifies soaring prices, they are most dangerously mistaken. As a result, French investors began pulling money out of the U.S., and German banks were reducing their exposure. These actions reflected an awareness that the markets had become overextended and the risks of a collapse inherent in such widespread exuberance and disconnection from economic realities. Throughout 1929, the most experienced and resourceful investors, those with extensive knowledge of market cycles, often called this smart money or institutional money, began withdrawing their assets. This group, which had survived multiple booms and busts over the years, was silently leaving the market, recognizing the signs of impending trouble. Even the Federal Reserve itself was attempting to curb the growing speculation. They had been gradually increasing interest rates, raising the discount rate from 5% at the beginning of the year to 6% by August, hoping this would slow down reckless lending and buying. Additionally, they resorted to what was essentially rhetorical pressure, publicly urging banks to restrain lending for speculative ventures, commonly known as jawboning. Yet, despite these efforts, the market defied expectations and kept climbing higher. Why was this happening? The answer lay in the shadow banking sector, specifically the calm money market, which was offering such exorbitant rates that money from outside regular banking channels, corporations, wealthy individuals, and even foreign investors flooded into it. These investors were lending to brokers at interest rates so attractive that the lure of quick returns easily outweighed the risks. The Federal Reserve's traditional tools, adjustments to interest rates and banking regulations, were powerless against this clandestine and extensive financial flow, which operated beyond the central bank's oversight. This disconnect should have been alarming for policymakers and seasoned traders alike, as it indicated that the central bank lacked genuine control over the broader credit system. When the inevitable collapse occurs, those who trusted in the Fed's power would be shocked to learn just how limited their influence truly was, because much of the speculative funding was coming from sources outside their reach. Adding to the ominous signs, insiders, those with the most intimate knowledge of their company's financial health, were liquidating their holdings in massive quantities throughout the year. These corporate executives and board members were not executing typical diversification strategies. Their sales were deliberate, and substantial, sometimes as high as 50, 60, or even 70% of their shares. They understood that the soaring stock prices were unjustified by actual earnings growth, which was often flat or slow. They knew the market had priced in years of prosperity that might never materialize. When reality eventually reasserted itself, these stocks would plummet, leaving those who bought into the hype with significant losses. Remarkably, some of these insiders were simultaneously telling the public that business conditions had never been better, claiming their companies were at peak strength, and urging investors to hold or acquire more stock. They knew they were providing a distorted picture, omitting the critical truth that the sky-high valuations were disconnected from fundamental earnings. This deception, while technically not outright fraud, was a calculated omission, a form of legal fraud by silence. Meanwhile, trading volumes on the New York Stock Exchange revealed further warning signs to those able to interpret them. In September of 1929, daily trading volumes soared to record levels, reaching 3 and 4 million shares daily, with some days that, a few years earlier, would have been considered extraordinary. At first glance, such activity might seem like robust investor enthusiasm. However, disciplined traders understood that during a mature bull market, excessive volume, especially at such elevated levels, often signals distribution. That is, the smart money was gradually selling off its positions to the less experienced investors who were eager to buy and believed they were riding the wave of an unstoppable boom. This pattern, large institutions unloading shares while retail investors impulsively buy, is a classic sign of an approaching market peak and an impending reversal. This marks the third stage of the pattern, when warning signals become evident. The wise investors and institutional insiders begin quietly withdrawing, liquidating their holdings before the chaos fully unfolds. Professionals start to hedge their positions, shielding themselves from potential losses. Yet, the general public remains oblivious, too intoxicated by recent gains to notice that exit routes are closing off. By September 3, 1929, the market hits its peak. The Dow Jones Industrial Average closes at a record of 381.17, a level that won't be reached again for another quarter century, until 1954. At this point, the average stock trades at an astronomical price-to-earnings ratio of about 32, with some even higher. For example, RCA, the flagship technology stock of the era, trades at an infinite PE ratio because it distributes no dividends and reinvests all earnings into expansion. Investors loan money to buy these shares solely for the hope of price appreciation. Similarly, industrial giants like General Electric and General Motors also command exorbitant multiples, 35 and 40 times earnings respectively, despite producing tangible goods and generating real revenues. Their valuations now resemble those of modern tech startups, disconnected from their underlying fundamentals. A critical detail often overlooked at this stage is that corporate earnings have already peaked. In the second quarter of 1929, profits hit their highest point, but by the third quarter, they begin to decline. Industrial activity slows, factory orders decrease, and commodity prices weaken. The economy itself is faltering. Despite these worrying signs, stock prices continue to soar for another 3 months, wholly detached from reality. This widening gap between valuation and actual economic health characterizes what is called the fourth stage of the pattern, when prices drift further away from the tangible groundwork and are driven solely by optimism, momentum, and the belief that the upward climb will never end. This distorted optimism is justified through a mindset dubbed New Era thinking, a phrase repeated often in newspapers, investment advisories, and journals of the time. Investors are convinced that they are entering a novel epoch where traditional rules no longer apply because technological advancements, like radio, automobiles, and electrification, have transformed productivity. They believe that companies can grow indefinitely, that the tide of innovation guarantees permanent prosperity, and that stock prices are simply reflecting a bright, unstoppable future. In October of 1929, Irving Fisher, then the most renowned economist in America and a pioneering thinker in economic theory, delivered a speech stating that stock prices had reached what looks like a permanently high plateau. His words reflected a genuine belief that fundamental economic shifts validated the lofty valuations. Yet, he was mistaken. His conviction was based on optimism rather than reality, and history proved otherwise. At that moment, the newspapers echoed this sentiment, published numerous articles proclaiming that stocks could only go higher. The Saturday Evening Post ran headlines like "Everybody ought to be rich," while investment advisors urged clients to hold or add to their stock holdings, dismissing concerns about overvaluations. Skeptics, who questioned the sustainability of such lofty prices, faced ridicule and were dismissed as old-fashioned or unenlightened about the new economic paradigm. Everyone, it seemed, was convinced that this era of unprecedented growth was here to stay, and those who dared to question it were considered outdated or naive. This psychological transformation is fundamental to understanding market behavior. It's no longer just about the elevated prices. It's about how those lofty valuations justify themselves. When stocks soar by 300%, many believe that this surge itself validates their worth. The market's efficiency is often cited, that if stocks were truly overvalued, they would be declining. Since they are climbing, the logic goes, they must be reasonably valued. This reasoning, however, is circular, masking itself as seasoned wisdom. It's an inevitable trap because any attempt to challenge this narrative is swiftly dismissed as pessimism or mere ignorance. This pattern wasn't unique to stocks. Earlier in the decade, real estate followed the same trajectory. In the mid-1920s, Florida experienced a land boom of devastating proportions. Swampland was subdivided and sold to speculators who never intended to develop it, merely aiming to flip it at a higher price. Land values soared to ridiculous levels, driven entirely by the belief that prices would forever continue to climb. When the bubble burst in 1926, thousands lost everything, serving as a stark warning. Yet, instead of heeding it, the psychology simply shifted from land to stocks. The same irrational belief in automatic appreciation persisted, coupled with a persistent dismissal of potential risks. By September of 1929, stock ownership had become a symbol of social sophistication. Not owning stocks was akin to being left behind, missing out on the societal party of prosperity. Conversations during dinner revolved around which stocks were trending, and cocktail parties turned into informal investment forums filled with bragging about gains or lamenting exaggerated losses. Everywhere, social proof reinforced the idea that everyone was participating, so it must be the right thing to do. At this stage, stage 4, valuations reached levels that defied any rational, mathematical explanation. Skepticism was viewed as ignorance, and the phrase, "this time is different," became a mantra, elevating hope over reality. Now, let's consider what unfolded next. The crash didn't begin with a sudden plunge. It started subtly, with a crack. On Thursday, October 24th, the market opened with intense sell-off pressure. By early afternoon, the Dow had dropped 11%, but panic had not yet set in. Rather, it was an abnormal but contained event. Brokers scrambled to respond, issuing margin calls to investors who had borrowed heavily. Many investors found themselves unable to meet these demands. They didn't have additional funds on hand, having already leveraged their holdings to the limit. The sell-off was driven by necessity, not panic, an enforced liquidation, mathematical in nature. When your margin ratio is 10 to 1 and prices fall by 10%, you are forced to sell your stocks, whether you want to or not. By midday, the ticker tape was 3 hours behind. Trading floors continued to operate, but across the country, investors remained unaware of the real-time values. This created a fog of uncertainty. People wondered if they had lost everything or if they were still afloat. Amid this confusion, a crucial moment unfolded around 12:30 in the afternoon. A group of influential bankers gathered at the offices of J.P. Morgan, including Thomas Lamont, Albert Wiggin, and Charles Mitchell, titans of American finance. Their aim was to address the mounting turmoil before it spiraled further. These were the leading giants of American finance, the industry titans who quickly announced they were forming a consortium aimed at stabilizing the collapsing market. Their plan was to purchase stocks en masse in an effort to halt the panic, and for a brief window, about 4 hours, it seemed to work. The market temporarily stabilized and even rallied, trimming some losses before the close. The following day, Friday, brought a sense of calm, and over the weekend, Despite the markets being shut, newspapers heralded the so-called rescue, claiming that the crisis had been averted and that everything was under control. However, this illusion of stability was false. Over the weekend, thousands of investors received margin calls by mail, warnings demanding they either deposit additional funds or face forced liquidation of their positions. When markets opened on Monday morning, October 28th, chaos resumed with massive selling. The Dow Jones Industrial Average plummeted by over 13% in a single day, and nearly 9 million shares traded, an unprecedented volume that set a new record. But the real catastrophe struck on Tuesday, October 29th, what history would forever remember as Black Tuesday. The market opened with a torrent of sell orders, as everyone desperately sought to sell and no one was willing to buy. For hours immediately after the opening bell, ticker tapes fell behind, unable to keep up with the frantic selling. By the end of that relentless day, a staggering 16 million shares had traded, a record that would stand for decades. The Dow itself declined another 12%, and over just 2 days, the market had lost a quarter of its value, 25% in total. And this was only the beginning. Over the ensuing 3 years, the Dow would plunge from its peak of 381 to a mere 41, a devastating 89% collapse, marking the worst bear market in American history. The destruction was not confined to stocks alone. Investment trusts, leveraged vehicles designed to amplify gains during euphoric times, did the same with losses, magnifying the damage. The Goldman Sachs Trading Corporation, which had launched at $100 a share in December of 1928 and soared to $326, tumbled to just $1.75, an almost complete wipeout of value, a 99% loss. Similarly, the nested trusts Shenandoah and Blue Ridge, which relied on leverage, essentially went to zero, vaporizing billions in wealth in the process. This moment marked stage 5 of a recurring pattern, the crack. It was when forced selling overwhelmed all demand and leverage unwound with violent intensity. The mathematics behind margin calls and liquidation created a self-reinforcing cascade, feeding on itself as each attempt to stem the losses only fueled further decline. What is crucial to understand is that the crash itself did not cause the Great Depression. It served as the trigger, but the deeper economic catastrophe that followed, what we now call the Depression, stemmed from what happened next. Stage 6 unfolded in the aftermath of the crash. The financial devastation wiped out the balance sheets of investors. Those who had been millionaires in September were bankrupted by November. But the crisis extended far beyond individual losses. Banks had lent heavily for stock purchases. When investors refused or were unable to repay, those banks suffered losses. To conserve capital, they had to tighten lending practices, which meant less credit available for businesses. Without access to loans, whether for payroll, inventory, or expansion, businesses could not operate, leading to widespread layoffs. As workers lost their jobs, they couldn't meet mortgage or car loan payments, causing further losses for banks, which then tightened credit even more. This vicious cycle spiraled out of control. By 1930, hundreds of banks had failed. More than 300 alone shut their doors in that year. Without a federal deposit insurance scheme, something that had yet to be established, people's savings vanished overnight. The economic fallout was devastating and widespread, setting the stage for the decade-long hardship that was about to grip the nation. When a bank fails, all the money that was held there vanishes overnight. This sudden loss triggers a second wave of panic as people rush to withdraw their savings before their bank collapses completely. But the problem is that banks don't keep all depositors' money in cash. They lend most of it out to other borrowers. When everyone attempts to withdraw their funds simultaneously, the bank can't fulfill those demands, leading to even healthy banks failing under the pressure of runs. By 1933, more than 10,000 banks had shut their doors, effectively wiping out half of the entire banking system. The situation worsens with a phenomenon known as debt deflation, an insidious process that transforms a recession into a full-blown depression. Here's how it unfolds. As asset prices plummet, businesses fail and banks collapse. The total money supply contracts, meaning less money is circulating in the economy. With less cash available and the same amount of goods to buy, prices begin to fall, a process called deflation. On the surface, falling prices might seem beneficial, making goods cheaper. However, in an economy deeply burdened by debt, deflation is disastrous because it increases the real debt burden. For example, imagine borrowing $10,000 in 1929 when bread costs 10 cents per loaf. That debt amounts to 1 million loaves of bread. By 1933, if bread price drops to 5 cents, the same $10,000 now equals 2 million loaves, a double debt load, even though the nominal debt remains unchanged. Multiply this effect across millions of debtors, farmers with mortgages, businesses seeking expansion, homeowners refinanced loans, and you have a collapsing wave of defaults. Each default causes banks to incur more losses, which leads to further failures and more deflation, a vicious death spiral. By 1933, the U.S. economy had shrunk by nearly 30%. Unemployment reached 25%, industrial output had halved, and international trade fallen by more than 65%. This was no longer merely an American crisis. It was global. The interconnectedness of economies through the gold standard, international trade, and accumulated debt meant that when the U.S. teetered, the entire world was pulled into the downer. The initial shock set off a cascade: falling asset prices, shrinking credit, widespread defaults, and deepening deflation, each intensifying the next. The economy didn't simply adjust gradually, it convulsed uncontrollably. Finally, we reached the aftermath, the realization that the damage is lasting and deep, and that the recovery, if it comes at all, will take years. By 1933, confidence in the entire financial system was shattered, and faith in capitalism itself was wavering. People looked at breadlines and shanty towns and questioned whether the American experiment had failed entirely. Desperation bred radical politics. In Germany, economic despair helped bring Hitler to power, while in America, Franklin D. Roosevelt won a sweeping victory, initiating a dramatic expansion of federal authority. The New Deal era introduced programs like Social Security, unemployment insurance, federal deposit insurance, and securities regulation, measures not driven by ideology, but by urgent necessity to prevent total social collapse. These policies reshaped society forever, marking the near ending of an era of unrestrained capitalism and setting the foundation for a new economic order. Their emergency measures to stave off total social chaos and the permanent transformation of monetary policy have left a lasting legacy. In 1933, President Franklin D. Roosevelt took decisive action by abandoning the gold standard domestically, effectively devaluing the dollar and confiscating gold holdings. This move represented a de facto default on the government's commitment to exchange currency for a fixed amount of gold. Over the subsequent decade, the economy endured a painful, gradual stabilization, but genuine recovery remained elusive until the onset of World War II, which required monumental government expenditure and industrial mobilization. Truly, a global conflict was what finally pulled the economy out of its slump. This period marks Stage 7, the aftermath, where the economy finds a new, lower equilibrium, leaving behind a trail of lost wealth and shattered public trust. Entire generations' financial stability and confidence are destroyed, and the societal fabric undergoes fundamental and lasting changes. Today, this history isn't just a lesson in the past, it's a warning for the present. By 2025, all 7 stages of this destructive pattern are clearly evident. The initial phase, characterized by reckless borrowing and artificial prosperity, is unmistakably underway. From 2008 to 2022, the Federal Reserve kept interest rates near zero most of the time, flooding the system with over $8 trillion through quantitative easing. The European Central Bank and the Bank of Japan went even further, experimenting with negative interest rates. For more than a decade, this global financial system operated on virtually free money. During this period, corporate debt in the United States ballooned from $7 trillion to over $12 trillion, much of it diverted from productive investments into share buybacks and dividends. Instead of funding factories or innovation, money was funneled into financial engineering. Household debt has returned to pre-minus 2008 levels, with credit card debt hitting $1 trillion, student loans nearing $2 trillion, auto loans at $1.5 trillion, and mortgages surpassing $12 trillion. Overall, total household debt now exceeds $18 trillion, more than $60,000 for every man, woman, and child in America. And globally, total debt is over $315 trillion, triple the entire world's GDP, the largest debt burden ever seen in human history. Having surpassed the numbers of 29, we now enter stage 2, speculation overtaking genuine investment. In the past 5 years alone, we've witnessed an array of warning signs. Meme stocks such as GameStop and AMC, driven by Reddit forums, have soared to valuations disconnected from their underlying businesses. Digital assets like NFTs, non-fungible tokens, have sold for millions of dollars each, despite producing no tangible value. Blank check companies, special purpose acquisition vehicles, have raised billions without specifying what assets they'll acquire. Cryptocurrencies such as Bitcoin and countless altcoins boast market values in the trillions, yet they generate nothing and are backed by no real assets. Retail traders, often inexperienced, are buying options they don't understand, flooding markets during COVID lockdowns with day trades originating from bedrooms. Companies with no profits are trading at 50, 100 times their revenue, with Tesla at one point boasting a market capitalization surpassing all other automakers combined, despite selling only a fraction of the vehicles. This surge in speculative activity signals an escalating divergence from real economic fundamentals and ample evidence of a financial environment increasingly driven by hype and collective delusion. All these patterns foreshadow an impending correction, a scenario where rising valuations based purely on sentiment, with little regard for actual productivity or earnings, set the stage for a reckoning. And then there's the so-called everything bubble, where stocks, bonds, real estate, commodities, and cryptocurrencies all surge together. Such a phenomenon doesn't occur when resources are allocated rationally or based on economic fundamentals. Instead, it arises when an excessive amount of money chases a limited number of genuine investment opportunities. In this environment, speculation has overtaken productive activity as the primary driver of economic growth. Today, more wealth is generated through trading assets than by producing goods or offering services. High-frequency trading algorithms, operating within milliseconds, aren't truly investing. They're just capturing tiny profits from market volatility. Meanwhile, day traders often cannot even name the CEOs of the companies they own, while retail investors follow tips from Twitter influencers and TikTok personalities. This isn't capitalism. It's a casino where most believe they're playing with house money, not realizing the risks they're taking. Having completed the second stage, we now move into the third. The smart money begins to quietly exit. Warren Buffett, for example, is currently sitting on over $325 billion in cash, more than ever before in his company's history, yet he's not rushing to deploy it. Corporate insiders, too, are selling at record levels. CEOs and board members unload shares while publicly expressing confidence in their firms. They see what most retail investors fail to recognize, the obvious signs of danger. Hedge funds, meanwhile, have amassed their largest short positions in history, betting billions on declines, not out of pessimism, but because they understand the mathematical signals that have always preceded market crashes. Foreign investors are also reducing their holdings of U.S. stocks and bonds, with central banks outside America purchasing gold instead of treasuries. This is a clear vote of no confidence in dollar-denominated assets, and the signals are unmistakable for those who know how to interpret them. Yet most people remain oblivious, repeating the mistake of 1929, seeing stock markets at record highs and assuming it's time to buy, without grasping that such peaks in a mature bull run are often the most perilous moments to enter. Having completed the third stage, we now reach the fourth. Prices soar to absurd valuations justified by the belief in a new era. This pattern should sound familiar. It echoes the dot-com bubble of 2000, the housing bubble of 2006, and now, today. The repeated refrain is, "This time is different." The excuses are always the same. Advances in technology have transformed everything, rendering traditional valuation metrics obsolete. The current narrative attributes sky-high valuations to artificial intelligence, digital transformation, or the so-called Fourth Industrial Revolution. Just as in the past, when radio and automobiles revolutionized industry and justified exuberance. These claims serve to rationalize rapidly inflating numbers. For instance, some companies are valued in the hundreds of billions despite losing billions of dollars, based solely on expectations of future dominance and disruption. Why? Because investors believe they're on the brink of the next big thing, even if that next is just a narrative. Take Tesla, which trades at a higher multiple than Ferrari, despite Ferrari's higher margins and proven profitability. Why? Because Tesla is framed not merely as a car manufacturer, but as a technology, AI, or even an energy company, whatever story investors find compelling enough to justify the price. Now, consider the case of cryptocurrencies. Trillions in market value assigned to assets that produce no dividends, generate no cash flow, and have no earnings whatsoever. Their value hinges solely on collective belief that someone will pay more for them in the future. That is not investment. It's pure speculation, driven by the herd's faith rather than any intrinsic worth. The belief that someone will pay more tomorrow isn't true investment. It's speculation driven solely by collective illusion. When skeptics raise this point, they're often dismissed as outdated or ignorant, accused of not understanding blockchain or decentralization, as if new technologies somehow exempted us from old risks. This dismissive attitude mirrors the mindset of 1929 as bubbles grew unchecked. Today, we're in what's known as Stage 5. The inevitable crack awaits, though it hasn't yet occurred. We're on the cusp, where leverage is maximized, confidence is at an all-time high, and the masses believe nothing can go wrong. That's precisely the moment when disaster strikes. The financial logic that brought markets crashing in 1929 remains unchanged. It's still perfectly valid. When everyone owns assets bought with borrowed money, with balances inflated by leverage, and the system relies on rising prices, even a slight downturn can unleash a chain reaction. Margin calls trigger forced sales, prices plummet, and more margin calls ensue. This cascade becomes unstoppable. What's different now is the scale and speed of this process. In 1929, margin calls traveled by mail, taking days to execute. Today, thanks to algorithmic trading, automated margin systems, and high-frequency programs, everything unfolds within seconds. When the selling begins, it will outpace human comprehension, causing markets to plunge before anyone can react. Circuit breakers will activate, halting trading temporarily, but once markets reopen, offers will flood in at pennies on the dollar. Nobody wants to catch a falling knife. We are currently in Stage 5, waiting patiently for the inevitable crack. Once it happens, Stages 6 and 7 will follow with relentless precision. The cascade, the aftermath, and a decade of rebuilding. Most overlook one critical insight about 1929. Its collapse wasn't random. It was mathematically guaranteed. Not because of some distant war or a single event, but because credit had outstripped income, speculation had replaced production, and everyone convinced themselves that rising prices would continue forever. This makes the system inherently unstable, not metaphorically, but mathematically. Unstable systems don't gradually adjust, they collapse abruptly. The question was always only when, not if. Today, the mathematics remains unchanged. Our collective psychology has yet to evolve. We've merely convinced ourselves that modern technology and policies make us immune. But the pattern is actively playing out. We're in Stage 5 of 7, and the inevitable is approaching. History offers a blueprint. When the tipping point arrives, those prepared will survive, and those unprepared will lose everything. The pattern is clear, the stages are marked, and the future is known because it's been seen before, 3 times already, in 1929, 1989, and 2008. Understanding this isn't about fear, it's about preparedness. When the next crash comes, it won't be your fault. Surviving it, however, will depend on whether you heed the lessons of history. The path is laid out. The warning signs are visible. The question is whether you will recognize them before it's too late.